Stop watching the gold price. Seriously. Because the real story isn't the number on your screen, it's what the number is trying to run away from. Right now, precious metals aren't acting like they're rallying. They're acting like they're being relabeled in real time. Like the market is quietly saying, that old price tag, yeah, rip it off. And if you've been around long enough, you know the moment I'm talking about. Pullbacks get shorter, pauses get tighter, and then one random headline hits and the move looks less like investing and more like a trap door. Before we go further, quick favor. I'm running a campaign to eliminate copycat channels. If you value this content, hit subscribe and comment John AG so the algorithm knows who the real one is. And for the record, as I'm recording this, it's Friday, January 23rd, 2026, 10 a.m. Comment the time you're watching because I want to see where in the world this message is landing. Now, here's the part most people miss. The next move in metals may not feel like a normal breakout. It may feel like a door slamming. Most people are being taught to look at this moment the wrong way. Turn on financial TV, scroll social media, or skim headlines, and you'll hear the same shallow explanations on repeat. Gold is up because inflation. Silver is moving because speculation. Rates will fix it. This is just another cycle. That framing is comfortable. It's also misleading. Because what's happening right now isn't about price direction. It's about system stress. Mainstream narratives love clean causes and neat explanations because they're easy to digest. But real financial shifts don't announce themselves that way. They show up first in places most people ignore. Bond auctions, balance sheets, settlement mechanics, and quiet changes in language from policymakers. Here's the mistake. People are treating gold and silver like trades when the market is starting to treat them like signals. Signals of what? That the financial system is absorbing more pressure than it's designed to handle politely. When markets are healthy, prices move with patience. They wait for data. They respect levels. They pull back normally. But when confidence starts to thin, price behavior changes. It stops asking for permission. That's what we're seeing hints of now. This isn't about one headline, one election, or one rate decision. It's about structure. How much debt exists, how it's financed, and what happens when the cost of carrying that debt collides with political reality. And this is where my analytical lens differs from the mainstream. Instead of asking, why is silver up today? I'm asking, what pressure is the system trying to release? Because markets don't move first where people are looking. They move first where people aren't. Let's slow this down and anchor everything in verifiable facts, not emotion. As of late January 2026, precious metals are trading at levels that would have sounded unrealistic just a few years ago. Gold has been hovering near the $4,900 to $5,000 per ounce range, while silver has been pressing toward the $95 to $100 psychological zone. Those numbers matter, but not in isolation. What matters more is why they're happening alongside other stress signals. Start with government debt. In the most recent completed fiscal year, the United States ran a deficit of roughly $1.8 trillion. Interest expense alone has crossed $1 trillion annually, making it one of the fastest growing federal spending categories. This isn't a political talking point. It's arithmetic. Higher rates mean higher servicing costs on an already massive debt load. Now look at the bond market. U.S. long-term Treasury yields have remained elevated and volatile. The 30-year Treasury yield has been fluctuating in the upper 4% range, a level that creates real strain for governments, pension funds, and institutions that depend on bond price stability. Similar stress is visible elsewhere. Long-dated UK gilt yields have traded near 5%, and Japanese officials have openly expressed concern over rapid moves in long-term rates. Bond markets are supposed to be boring. When they aren't, something is off. Next, silver supply and demand. Global silver demand in 2024 totaled roughly 1.16 billion ounces, according to industry data. Industrial demand reached a record driven by electronics, electrical applications, medical uses, and especially solar energy. The solar sector alone consumed an estimated 200 million ounces of silver, roughly one-fifth of total global demand. On the supply side, silver production has struggled to keep pace. In recent years, the market has run structural deficits, with demand exceeding supply by tens of millions of ounces annually. Importantly, much of silver production comes as a byproduct of mining other metals like copper and zinc. That makes supply response slow and inflexible. Now zoom out to central banks. Throughout 2025, central banks continued accumulating gold at historically high levels, with quarterly purchases measured in the hundreds of tons during certain periods. This isn't retail panic. This is institutional reserve management, entities hedging against currency and systemic risk. None of these data points alone predict a crisis, but together they describe a system under pressure: high debt, expensive financing, fragile bonds, rising industrial metal demand, and official institutions quietly hedging. Those are the facts. What they mean strategically is the next step. When you put those facts together, a different picture starts to emerge. Not a prediction, but a strategic landscape. One possible explanation is that markets are beginning to question the long-term stability of government debt without openly panicking yet. This isn't a collapse scenario. It's something more subtle and, historically, more dangerous. A credibility test. When debt levels rise faster than income and interest costs grow faster than tax revenue, policymakers are boxed in. They can cut spending, raise taxes, or manage the problem through monetary tools. In modern systems, the path of least resistance has usually been monetary accommodation. That doesn't automatically mean runaway inflation tomorrow. What it may indicate is a willingness to absorb financial stress through the currency rather than through defaults or visible austerity. From a strategic perspective, this environment tends to favor assets with three traits: no counterparty risk, limited supply growth, long historical credibility. Gold fits that profile cleanly. Silver does too, with an important twist. Silver sits at the intersection of monetary asset and industrial input. That dual role makes it volatile, but it also gives it leverage during transitions. When confidence weakens, gold is often the first responder. Silver tends to lag and then accelerate sharply once participation broadens. The gold-to-silver ratio helps illustrate this shift. When the ratio compresses rapidly, it suggests silver is moving from secondary metal to primary vehicle in the eyes of the market. That doesn't require physical shortages overnight. It requires perceived scarcity, doubts about whether metal can be delivered when needed, at scale, under stress. Who benefits from this shift? Entities holding tangible assets, energy resources, and pricing power tend to gain flexibility. Institutions that hedged early reduce volatility in their balance sheets. Governments benefit short-term if asset inflation helps offset debt burdens. Who loses? Fixed income holders exposed to duration risk, savers whose returns lag real purchasing power, anyone relying on stability in systems designed for lower debt and lower rates. None of this guarantees a straight-line move higher in metals. In fact, historical precedent suggests volatility increases during transitions. Sharp pullbacks, false breaks, and sudden reversals are common. Not because the thesis is wrong, but because leverage and positioning get flushed. Strategically, what we're likely seeing is not a speculative frenzy, but an early-stage repricing of trust. And trust, once questioned, doesn't rebuild overnight. When financial stress moves beyond isolated markets, it doesn't stay contained. It spreads quietly at first, then all at once. If long-term government debt continues to face credibility pressure, the consequences ripple through every major system tied to it. Start with markets. Equities depend on discounted future cash flows. Bonds provide the discount rate. When bond markets become unstable, equity valuations lose their anchor. That doesn't mean stocks immediately crash. It means volatility rises and correlations tighten. In stressed environments, diversification often fails right when people expect it to work. Now, banks. Banks rely on government bonds as high-quality collateral. They use them to secure funding and manage liquidity. When bond prices fall sharply or fluctuate unpredictably, balance sheets become harder to manage. That forces institutions to either reduce risk exposure or seek liquidity support, both of which can tighten credit conditions for the real economy. Next, currencies. When governments lean on monetary tools to stabilize debt markets, the currency absorbs the adjustment. Sometimes that looks like inflation. Sometimes it looks like depreciation. Often it looks like persistent loss of purchasing power rather than a dramatic event. That erosion isn't always visible week to week, but it compounds. Then governments themselves. Rising interest costs crowd out other spending. Political choices narrow. Leaders face pressure to protect growth, employment, and financial stability simultaneously, goals that often conflict. Historically, this is where policymakers favor solutions that delay pain rather than eliminate it. Globally, the effects don't stop at borders. Capital flows respond to perceived safety. Reserve managers reassess exposure. Trade relationships shift. In periods like this, assets with universal acceptance, commodities, energy, precious metals, tend to play a larger role in settlement and reserves, even informally. This is how systemic transitions usually unfold. Not with a single dramatic collapse, but with layered stress that forces adaptation across institutions. Markets begin pricing not just earnings or yields, but resilience. Countries with fiscal flexibility gain leverage. Those without it face tougher choices. Precious metals don't cause these shifts. They reflect them. They act as mirrors, showing where confidence is thinning and where the system is compensating through currency and liquidity rather than structural reform. Understanding this bigger picture matters because it's the bridge between abstract macro forces and everyday decisions. That bridge is where most people get lost. All of this can sound abstract until it shows up in places you actually feel. Macro stress doesn't announce itself with a press release. It creeps into daily life through costs, choices, and uncertainty. Start with savings. When interest rates rise but inflation-adjusted returns remain weak, the money sitting in savings accounts quietly loses purchasing power. You're doing the responsible thing, yet over time that cash buys less. Groceries, healthcare, education, housing. That erosion doesn't feel dramatic in any single month, but over years it changes outcomes. Now investments. Traditional portfolios were built for a world where bonds stabilize stocks. In periods of systemic stress, that relationship can break down. Investors find themselves exposed to volatility they didn't plan for, not because they took excessive risk, but because the environment changed. Jobs and wages are next. When borrowing costs stay elevated and credit tightens, businesses slow hiring, delay expansion, or cut back on investment. That pressure shows up unevenly. Some sectors remain strong, others weaken quickly. Job security becomes less about performance and more about which side of the cycle your industry sits on. Then there's cost of living. Energy, food, insurance, and housing don't move independently. They're connected through financing and logistics. When the currency absorbs systemic stress, those costs tend to drift higher, even when demand slows. That's why people often feel squeezed during periods that don't look like classic inflation on paper. And finally, family planning. Big decisions, buying a home, starting a business, supporting aging parents, saving for kids, depend on confidence in the future. Systemic uncertainty doesn't just affect portfolios, it affects timelines. People delay, downsize, or change plans entirely. This is why understanding the macro matters. Not so you can predict every market move, but so you don't mistake structural change for personal failure. Many people blame themselves for outcomes that were shaped by forces far larger than individual choices. The goal isn't fear. The goal is awareness. When you understand the pressures shaping the system, you're better equipped to protect flexibility, financial, professional, and personal. And that's where a framework becomes essential. This is where I want to give you something that lasts longer than any single forecast. I call this way of thinking the structural pressure lens. Instead of asking, what will the price do next? You ask, where is pressure building, and how is the system trying to release it? Every complex system handles stress in predictable ways. When pressure rises, it can be released through defaults, one-worm, austerity, growth, inflation, currency debasement, asset repricing. The structural pressure lens simply tracks which release valves are politically and financially acceptable at a given moment. In the United States, large-scale defaults are taboo. Severe austerity is politically toxic. Rapid growth is difficult with high debt and high rates. So pressure tends to flow toward the remaining outlets: monetary flexibility, currency dilution, and asset repricing. This lens also forces you to separate noise from signal. Headlines change daily, narratives rotate weekly, but structural pressures move slowly until they don't. When you apply this framework, precious metals stop looking like speculative trades and start looking like pressure indicators. Bonds stop being boring instruments and start looking like stress gauges. Policy language becomes more important than policy promises. Most people lose money not because they lack information, but because they react to surface-level narratives instead of underlying forces. This framework doesn't tell you what to buy. It helps you understand why certain assets behave the way they do, why volatility increases during transitions, why patience and discipline matter more than prediction. Once you learn to see pressure, you stop being surprised by outcomes. This is where theory turns into usefulness, not in the form of stock tips or price targets, but in how you operate when the system is under pressure. First, decide your role. Are you a long-term preserver of purchasing power, or are you trying to trade volatility? Those are different games. Mixing them usually leads to mistakes. If you don't define your role ahead of time, the market will define it for you, usually at the worst moment. Second, watch behavior, not commentary. Ignore predictions. Pay attention to how fast dips get bought, whether volatility expands or contracts, how policymakers describe stability, whether bond market stress is being acknowledged or minimized. Markets often tell the truth through action before words catch up. Third, plan for speed. During transitions, markets move faster than most people expect. Pullbacks that used to take weeks can happen in hours. Decide in advance how you'll respond to sudden drops or surges. Emotional decisions made in real time are almost always the wrong ones. Fourth, protect optionality. Liquidity isn't just cash, it's flexibility. Avoid structures that force you to sell during volatility. Excess leverage reduces your choices. Resilience increases them. Fifth, think in ratios and relationships. Instead of fixating on absolute prices, watch how assets behave relative to each other. Gold versus silver, commodities versus currencies, bonds versus equities. These relationships often signal regime shifts before headlines do. Finally, remember that doing nothing is still a decision. There will be periods where patience is the highest skill move. Sideways markets test conviction. They make people abandon sound strategies out of boredom or frustration. The goal isn't to outsmart the market. It's to stay functional while others get shaken out. If you can do that, if you can maintain clarity while pressure builds, you don't need perfect timing. If you take one thing away from this, let it be this. Markets don't move first because of excitement. They move because of pressure. Pressure from debt that can't be reduced easily. Pressure from systems designed for a different era. Pressure from policies that trade long-term stability for short-term calm. Precious metals aren't shouting right now. They're signaling, not about tomorrow's headline, but about the direction the system is leaning over time. You don't need to predict every move. You don't need to chase every rally. You don't need to panic when volatility shows up. What you need is awareness. Awareness of how stress flows through financial systems. Awareness of how currency, debt, and confidence interact. Awareness of your own goals, limits, and temperament. In periods like this, the biggest advantage isn't information, it's perspective. Perspective keeps you from mistaking noise for danger. Perspective keeps you from mistaking discomfort for failure. Perspective keeps you grounded while the measuring stick itself is changing. Stay curious, stay disciplined, and remember, assets with no counterparty risk don't need permission to matter. I'll see you in the next one.